Hello and welcome. Moss Adams is pleased that you've joined us for today's session, Understanding the Tax Cuts and Jobs Act for Agribusiness. Before we begin, I'm going to play our housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, we have two presenters with us today. Canada and Josh are both tax senior managers here at Moss Adams. Their bios and contact information are located in your webcast console. And now I will turn the floor over to Josh to get us started.
Hi, everybody. I want to thank everybody for taking the opportunity to join us today. We're going to talk a bit about the Tax Cuts and Jobs Act and how this is going to affect every taxpayer over the next couple of years. There's some really important changes coming up. We're going to talk about what to expect and hopefully give you some ideas for planning opportunities as we get closer to the end of the year. So a little bit of background on TCJA. This TCJA happened in 2018 as Trump took office, something that he was able to get voted into law in his first 100 days. This was the biggest change to the tax code in 30 years. I've been doing this for 15 years now. It seems like it's constantly changing and keeping us on our toes, but this was, touched the most areas of the tax code at once. And we've been feeling the effects for the last several years. Beginning in 2015, there are many provisions of the Tax Cuts and Jobs Act that are going to start sunsetting. There were a lot of changes that were wrote into law permanently, and there's a laundry list of things that are going to go away, and we will be reverting back to pre-2018 TCJA tax code. We're going to start off with a little bit of legislative history. In November 24, obviously we've got the presidential election coming up. Depending on who takes office, we are expecting to have another round of tax reform, but in what form, we really don't know yet. The idea that TCJA passed in Trump's first 100 days kind of gives some indication that if he were to take office, expect it to happen again, and that we'd see pretty significant tax reform happening before the end of 2015. It's a pretty heavy impact to our budget, and as these changes that we go through expire, tax rates are gonna effectively go. The corporate tax rate is fixed, the marginal tax rates are fixed, but the timing of how you recognize taxable income with these expiring provisions is going to cause a lot of companies to see income tax liabilities go up. Right now, the national debt is at $34.8 trillion. It's gone up over $1.5 trillion just in the last year. It doubled from 2013 to 2023. And so to continue to see tax reform where rates go down seems unlikely, because we're going to need to figure out how to slow this down or start to pay off some of this debt. Historically, we've had pretty high tax rates compared to today. From 1913 to 1964, tax rates, the top tax rate was 77%. In 1944, it was as high as 94%. We've had very high tax rates in the U.S. Over the last 100 years. Today, the highest individual marginal tax rate is 37%. You can get as high as 48% with the net investment income tax. But comparatively, over the last 110 years, these are pretty low tax rates. So I would be surprised if they stayed as low as they are. Because of this, if you're anticipating tax rates to go up, there are planning opportunities to look into your business's activities and find ways to accelerate income, recognize income now, accept the fact that you're going to pay a little bit more tax now, but less over time if rates are to go up. So I'm going to go through a few provisions that are set to sunset. 199A, the qualified business income deduction, was new with TCJA. Before TCJA, we had Code Section 199, the domestic production activities deduction. TCJA changed this so that it was only available to pass-through entities and self-employed people. There were some exempted activities. It was focused around services like architecture, attorneys, CPA firms who were not able to participate. But this benefit basically was built into the tax code to provide some similar benefit to self-employed people as to the corporate tax rate being reduced to 21%. 199A is going to sunset at the end of 2025. The corporate tax rate will not. And so will there be some replacement benefit for self-employed people, or will they write 199A into the law permanently? We don't know. There's been a lot of, obviously a lot of support to write 199A in permanently. When Trump talks about things that he anticipates doing for the economy, it's providing some benefit to manufacturing companies in the U.S. That's exactly what this code section does. And so, it's been around for a long time in some form. We've had 199 since 2004. I'd like to see this get written into law permanently. It's a great benefit for self-employed people, but we just don't know yet. And then I want to add a note for if there are any cooperatives on this call or any members of cooperatives on this call that receive an allocation of the 199A deduction. The sunsets at the end of 2025, but a lot of co-ops have fiscal year ends. The last time that they'll be able to take this deduction is in their fiscal year ended 2026. And if they wait to pass this deduction through until 2026, it's effectively a lost benefit. It won't be able to be claimed on a 2026 tax return. And so this happened back in 2017 when 199 was repealed. But fiscal year end cooperatives kind of had a scramble because it was repealed in December, where they had to do their DPAT allocations before December 31st. And what it meant to members of a co-op is that they effectively ended up with two allocations, one for the fiscal year ended in 2017 and one for the fiscal year ended 2018. And that was a deduction that got claimed on a 2017 return. Well, we're going to see that again. So co-ops need to do some planning and make sure that that allocation goes out for the end of 2025. Otherwise, their members are going to lose out on a pretty significant tax benefit. And at the bottom here, just some planning considerations. Do you think the 21% corporate rate will remain? I think this really depends on who takes office. Harris has mentioned a corporate rate somewhere around 25 to 27%. Trump wrote this law, and I would expect if he were to take office, we would get to see the 21% corporate rate stick around for a while. And then if you're an entity that's taking a pretty big benefit from the 199A deduction and it's going to expire, is this an opportunity for you to consider changing your entity type? I mentioned accelerating income into a low tax rate year if you're anticipating the rate going up. Accelerating income rather than deferring it, this may be a good year to do it. And then we're going to talk about some accounting methods to to identify potential opportunities that you may not already be taking advantage of to get to accelerated income. Okay, so bonus depreciation is another expiring provision. Between now and the end of 2026, it's going to phase out entirely. So for fixed assets placed in service before January 1st, 2025, the bonus depreciation rate is 60%. In 2025, it goes down to 40%, and then 20, and then in 2027, it's phased out entirely. Bonus depreciation has been around for a really long time, and in some form or another, we've had it be 50%, 100%, and now we're subject to this phase out. This is one of the provisions in our tax code that is written in really as like an economic stimulator. It incentivizes you to go buy more equipment. It's beneficial to the manufacturing companies building that equipment. I wouldn't be surprised to see bonus come back in some form, but under current law, it's going to go away. So to the extent that you can control the timing of placing assets in service for tax purposes, and you have projects that are in the works right now but not placed in service yet, and you have the opportunity to place them in service before year end, you can take advantage of a higher bonus rate. The tax rules for placing an asset in service are that the asset is available and ready for its intended use. And so you might have situations where you place an asset in service for tax purposes that doesn't follow GAAP. And so that's an important consideration. Look at your CIP before the end of the year. What is available, what's and ready? You just aren't using it yet for GAAP purposes. You may be able to place it in service and take some accelerated bonus depreciation this year. The 179 deduction is permanent. It's not leaving the code. The limitation is the same. You can use up to $1 million of Section 179 expense each year. It does phase out if fixed asset additions exceed $2.5 million, and it's inflation adjusted. 179 is not going anywhere.
Thanks, Josh. As you may all recall, so kind of with the TCJA, one of the big impacts for individuals was this $10,000 limitation on the amount of state and local tax deductions that an individual could take. This is actually set to expire, like most other TCJA items, at the end of 2025. The one thing that we do want to point out, yes, this is an individual deduction. However, a lot of the high income tax states, so think California, New York, in our neighboring states, Oregon, Idaho, who do have state income tax, they came around with a pass-through entity tax election, which is essentially a SALT workaround, where the company itself would take the business deduction and pay the state taxes, and then the individual owners would then take the credit on their state tax returns. So if this applies to your business, just be aware that this is expiring in 2025, and a lot of the states, including California, do have this expiration also at the end of 2025. So it's just something that needs to be taken in consideration for the next couple of years. The other thing that we do want to touch on, again, this excess business loss limitation came from TCJA. It is done at the non-corporate taxpayer, so our individuals in our trust. But the reason why it's important for us to mention when we're thinking about planning is because this is really kind of where Josh was mentioning, where we want to potentially take advantage of lower tax rates in 2024 and 2025 compared to the potentially higher tax rates 26 and going forward. So if you remember excess business loss limitation, it's been through quite a whirlwind of different changes. It was first enacted with TCJA. It was set to expire at 2025, just like a bunch of the other provisions. However, the Inflation Reduction Act of 2022 extended this provision through 2028. So even though a bunch of the other TCJA items are expiring, this one is going to stick around for a couple more years. So it's definitely important that businesses are taking this into consideration when we're talking about tax planning and kind of where we want income and whether or not you want to take those excess deductions like our bonus depreciation. The thing to note is the excess business limitation. The reason behind it is because they didn't want people generating business losses that can offset passive income. So think about like your other interest and dividends and capital gains. Any amount that is limited is allowed to be carried forward, and it's actually converted to an NOL. And so this amount is always adjusted for inflation. For 2024, the amount is $610,000 for any married filing jointly taxpayers. So in conjunction with excess business losses, we have net operating losses. This has also been through a whirlwind the past couple of years. So if we go back to 2018, TCJA really repealed the non-farming 2-year NOL carryback. So people were not allowed to carry back their NOLs anymore. However, NOL carry forwards are now allowed indefinitely. In 2020, the CARES Act, a lot of stuff was happening. They actually allowed a temporary 5-year NOL carryback for people through 2018 to 2020. And again, this was kind of just like an economic stimulus. They were aware that 2020 and 2020 were very rough years and people were generating net operating losses and they needed the cash. So they allowed an NOL carryback. Now that we're past that, the TCJA rules for NOL came back in effect in 2021. The biggest change is that any net operating loss carry forward can only offset 80% of taxable income. So really this means that taxpayers, even if they have losses from prior years, they're going to be paying a minimum 20% of tax on 20% of their taxable income. And again, any amount that's unused is carried forward indefinitely. And of course, because this is towards our farmers and our agribusiness clients, we do want to note that if the net operating loss that's generated in the current year is deemed to be from farming, you are allowed to carry it back 2 years. So this is a specific farming provision, and it's definitely something to consider, especially when we're thinking about lower tax rate years versus higher tax rate years, because that's really where we can do like a permanent tax savings. So this next kind of section is where we're going to be talking about a change that happened with TCJA that really helped a lot of small businesses. And when I'm saying small business, it's the technical definition is a small business that has average annual gross receipts of $25 million or less for the past 3 years. And that $25 million is always adjusted for inflation. So for 2024, the amount is $30 million. So the one caveat is that in order to be considered a small business taxpayer, you do need to look at the aggregation rules. And so any kind of related entities and related parties need to be considered. That can get quite complex and quite convoluted. So please feel free to reach out if we need to kind of do any planning on that side, but it's definitely something that should consider. Now, the next question is why does this even matter? Why do you want to be considered a small business? And the reason why is because if you are considered a small business taxpayer, a small business farmer, you're open to a plethora of kind of tax planning opportunities that otherwise you're not allowed and you're not eligible for. So with that is the cash basis of accounting. And as you all know, we looked at the attendee list. We got a lot of CEOs, CFOs on the attendee list. So we know you guys know this stuff. And this is really where if you're cash basis, you're paying taxes on cash received and cash paid. One caveat we do want to mention is when you're prepaying your farm supplies, you're really only allowed to deduct about 50%. The deduction amount cannot exceed 50% of your other farming expenses. So you can't just prepay a ton of expenses, but it's still a really good planning opportunity. And again, all of this needs to be considered with potential tax rates, and then also what's happening with qualified business income deduction, because all of these things interplay. And the kind of question is, if qualified business income deduction is going away, we'll have higher rates going forward. Do we push income in 2024 to 2025 rather than being aggressive for tax? Another huge benefit for small business taxpayers is how we account for inventory. A lot less stipulations. And one of the biggest ones is you don't have to do the additional tax capitalization or UNICAP rules. Those can be quite complex and convoluted, so that's something to definitely consider. You're also allowed to expense your pre-productive costs. So if you're technically not a small business firmer, there is a separate election that is irrevocable that can be done for this. However, that specific election requires all assets to be on the ADS method. So it's a little bit more convoluted than that, but if you're a small business taxpayer, you get the benefit. Another huge benefit is you are exempt from the business interest expense limitation. Josh is going to go into a little bit more detail as to what exactly that means. And there's a specific firmer exemption. So if you don't qualify under the small business firming or small business taxpayer, there is another opportunity there. Again, big caveat is even if you are technically under the 30 million of gross receipts, and if you are a farming syndicate, you are unfortunately unable or ineligible to apply these kind of preferential treatments. And a farming syndicate, very high level, is really if you are allowed to allocate 35% of your losses to what they call limited partners or limited entrepreneurs. The code and the regulations go into detail as to what exactly that means, but just something to note.
All right. Section 163J is the interest expense limitation. TCJA wrote this into law permanently, but it did have a year where the formula changed. So first of all, 163J is applicable to taxpayers that have average annual gross receipts over the last 3 years of $27 million or more. Limits your ability to deduct interest expense. The formula, when the code section first came into effect, was taxable income, and then you got to add back depreciation, amortization, interest income, and expense. Whatever that number was, times 30% was the maximum amount of interest expense you could deduct in a year. A couple of years ago, that formula changed. You can no longer add back depreciation and amortization. And so it did have a pretty significant impact if you're a company that had high interest expense. This is a permanent law. There was an attempt in the Tax Relief for American Families and Workers Act to kick the change in formula down the road a couple of years. That act passed the House in January, but it ultimately failed in the Senate in August. So we are stuck with this formula. There's an election that applies to farming businesses and ag cooperatives. You have the ability to elect out of this code section. But you do have to do kind of an analysis to determine whether or not the election is good for you. If you make the election, it's permanent. If you elect out, you're required to use ADS lives for tax depreciation, so slower lives, and you're no longer able to use bonus depreciation on assets that have a useful life of 10 years or more immediately before the election. And so it's not a blanket election for all co-ops. You do need to consider what's going to happen with CapEx over the next several years, as far out as you can forecast to understand the consequences of this election. What I've seen, not across the board, but where we have made elections out of this code section is most ag activities, their operating assets have useful lives less than 10 years. And so an election doesn't affect you. There will be instances where you don't get to use bonus on things like qualified improvement property. But that has typically been a small expense compared to purchasing normal operating assets. And so the impacts can be small depending on what it is that you're doing. But at the bottom of this slide, we noted a few industries that have asset class lives of 10 years or more. And so you do need to understand what asset class you fall into, that your operating assets fall into. A big one that gets carved out of this is trees or vines bearing fruit or nuts. That's a 10-year asset. And so if you make the selection, you can't use bonus depreciation anymore. So you do need to consider how you're affected by it. But in a lot of circumstances, it's been pretty inconsequential to elect out. The ERC credit, this wasn't TCJA. This came out of the CARES Act, but we thought it would be important to note because there's a lot of ERC claims out there and people are still waiting for money. This has been a really contested area because of the abuse happening on ERC credits and the boutique firms that popped up telling everybody they qualify. If you don't meet the gross receipts test or didn't have full or partial shutdown of operations, it's really difficult to qualify. And so if you took a claim citing supply chain disruption, the IRS has come out with a bunch of examples where the facts and circumstances-based examples where claims are being denied. There have been 28,000 disallowance letters sent out, 30,000 reversal or recapture letters saying you have to send the money back. But they are still processing a lot of claims. This is picking up a little bit as they get better at analyzing who is making a valid claim. Two voluntary disclosure programs have come out where if you think that you've requested money, but now you know you're not eligible, you can give the money back, most of the money back, keep some of it. But they're really trying to make an effort to claw back some of these funds. Billions of dollars of inappropriate ERC claims are out there, and they don't want to give the money away. All right, these provisions are not going to change. Mentioned the corporate tax rate's not going anywhere. NOL carry forward is permanent, no more carrybacks. The interest expense limitation is permanent. Like-kind exchanges are limited to real property. Research and experimentation costs, this is section 174. There's now a requirement to capitalize and amortize research and experimentation costs over a 5-year period. That's not going away. There's been a lot of movement to get this eliminated, but all tries have failed so far. And then the small business methods that Canada mentioned are also permanent. 179 is not going away, and the elimination of corporate AMT. However, there is a corporate AMT for companies that have financial statement of income of $1 billion or more. That eliminates probably most of the people on this call. We're no longer able to deduct entertainment costs or transportation fringe benefits. So if you're providing some transportation benefit to your employees, they consider that an untaxed fringe benefit. This code section means the company is on the hook for those benefits you provide to your employees. Also not in the TCJA, but the Corporate Transparency Act. You have until January 1st to do your beneficial ownership information reporting. This is new as of 2025. If your company existed before the beginning of this year, you have until the 1st of 2025 to report. But I do want to mention there are many exemptions to this reporting. One of them being if you have more than 20 full-time employees, an operating presence at a physical office in the U.S., and more than 5 million of gross receipts, you're not required to report. And that's gonna knock a lot of people on this call out of being required to report. We do encourage you, because there are some non-tax considerations to this reporting, to consult with your attorneys before the end of the year. But I think that exemption is going to knock a lot of people out. And then there are some pretty steep penalties for not reporting, up to $10,000 if you are late or don't report your BOI information by the deadline.
So in the essence of time, there's a couple of slides, and we know this slide deck is going to go out to people, so that's why we included them. We won't have enough time to go over them directly, but because this is centered towards our agribusiness clients, there's a bunch of different opportunities that are technically outside the scope of this presentation because they have nothing to do with TCJA, but we would be remiss to not include them. So feel free to take a look through this list. If you have any questions, feel free to reach out to Josh or I. One thing we do want to note is that there is a bill currently in Congress right now, and it's called the Supporting Innovation in Agriculture Act of 2024. It's not law, it's just out there. And what they're trying to do is create a new 30% credit for innovative agriculture technology projects. It's kind of a short bill, but it's out there. Who knows what will happen with it? We just wanted to make sure our clients and everyone who's attending today knows that it's out there. Again, in the essence of time, there's individual provisions, things that are changing. We don't need to go into detail. The slides are there for you to look over if you have questions. One big thing that we do need to mention is the estate exemption. So with TCJA, it roughly doubled the amount of lifetime exemption. So it went from 5 million to about 12 million. And So this is also going to sunset to expire. If you have an estate that's above this 27.22 million as a married couple or 13.61, it's probably time to do some tax planning and do some gifting. Valuations is also something that needs to be considered. They're probably down right now with everything that's happening in the market, so it could potentially a good time cost. And again, estate planning takes time. You have to get coordination with the valuation team, your attorneys, your CPAs. So if this is something that will impact you or your owners, it's definitely something that needs to be taken into consideration. Next steps in planning, really, again, we want to re-emphasize there's a lot that's sunsetting, there's a lot that's changing, and really it's kind of making sure you're modeling out what these changes would look like for your specific business. Think about accounting methods, if we should increase revenue in 2024 and 2025 to kind of take advantage of these items, or expenses should be pushed to 2026 to take advantage of the lower tax or of the higher tax rates later. So there's a lot of things that need to be modeled and planned. And if you have any questions, feel free to reach out to Josh and myself. Other than that, Amy, I'll hand it off to you to close us out.
All right. Well, thank you, Josh, and thank you, Canada, for a short and sweet webcast today. And then to our audience, if you do have further questions, you can drop a note now in the Q&A window or reach out to our presenters directly. Their contact information is in the console and in the slide deck, which you can download now from the handouts window. And then finally, here's a link to a survey for today's presentation. And again, thank you for joining us. Take care, everyone.
Thank you.
Thanks, everyone.